Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today I have an update for you, just having a review of the uranium thesis and how I'm playing it with the portfolio that's publicly available on eToro. I'll also give you a chance to access how I'm playing it privately in a much more leveraged fashion. So that being said, excuse me, I've had a bit of a cold recently, so if I cough, please forgive me. If you're looking to leverage this in both getting access to the a potential upside through trades that I'm making, or if you want to milk this trade with confidence in the underlying thesis and really squeeze the juice out of it to make some income, I'm sharing with you the options trades that I'm making. I have options trades on the short side and the long side, and so if you're interested in that, I share exactly what I'm doing with members of the Options Mavericks group. Links will be in the description. You can check it out, 7-day free trial, all that stuff. Disclaimer, of course, I'm not a financial advisor, so anything that you hear me say is not advice. It's simply what I'm doing, what I think. It may be right, it may be wrong. It may be right for me, it may be wrong for you. All those different permutations and combinations, okay? None of it's advice. This is just what I am doing. You do what you do your own due diligence, and that is it. Everything here is just my opinion. Okay, moving forwards. So uranium fuels, looking at the index, okay, the URA is an ETF with a bunch of uranium producers, a few trusts that buy uranium and then sequester that into warehouses and store it, with the idea being that they believe in the upside speculation. They believe the uranium price is going to go higher. These guys want to hoard it and then eventually to profit off that particular valuable asset in the future. So the idea, of course, would be that uranium price increases and these guys will make more money, right? And this is really the only one of two ways of which I know to play it on eToro. So that's why I'm talking about it. It's not my favorite ETF because you have some access to guys like, say, BHP, I believe, are still in there, where they do have uranium, but it's more of an off cut, so to speak. It's a byproduct of what they produce. It's not their main aim. Having said that, uranium spot is closed $55.60, long-term contracting at $60. I have a podcast due with my good friend Justin Hune in 2 weeks, so it'll be very interesting to really delve into the weeds in terms of where we are with this market. Both the conversion enrichment prices are up well over 100% in their respective spot markets over the last year. The U308 is up. That's about 12%, 11.5% year to date. So what's going on? Why has this spot price not risen, whereas these guys have? I believe it's just a delay. And that's what I believe. I'll be able to ask Justin a little bit more. Obviously, the theory being that we need high prices to incentivize new production. So these guys that have uranium deposits, but they're currently in care and maintenance, they're not mining those assets. Well, they're not going to go back to producing those assets until the price is such that it can justify their doing so and spending the enormous amount of capex needed to open and start that uranium mine. Why do we need new production at all? Well, we need that because we're getting super tight with supplies, and we've seen that. That is why the spot price has risen. It's almost doubled over the last 5 years. There's a brilliant Substack by Saad Khan. I'll leave the link here that really delves into this. It's publicly available. It's free, and I really recommend Saad's work. I've tried to get him on the channel. We're talking. He doesn't particularly want to do a podcast, but I'm gonna make him eventually, guys. I'm gonna make him. He's a genius. I really like his work. So comment if you want Saad to come on the channel. Make sure you put a comment in there and tag him in Substack. If we all start annoying him on Twitter and Substack, maybe he'll pay attention. So what I've done here, this is a graph showing the amount of tons contracted, or pounds, I should say, contracted in the long-term market per year. Okay, so if you look back into the bull market, look how much uranium was being contracted. Okay, was being signed for deals into the future. Then you run that with the spot price in the yellow rolling line here, and you'll see how that affected the spot price. So 185 million pounds a year. I've drawn a rough line there because that's roughly where the demand is at the moment globally. And that is, of course, expected to grow. Now, if I draw your attention here to after 2012, we had this massive drop off, okay? Where until recently in 2022, we weren't even seeing 100 million pounds a year being signed in the term contracts. So if the term market was basically dormant, well, not dormant, but severely reduced compared to where we were, you've had years of the difference between this line and the tops of these bars here that represents the difference between the demand and the contracted supply into the future. And so that has eaten through a lot of inventories. And now we're getting to the stage where those inventories must be being eaten through. Utilities are looking to re-sign their contracts so that they have fuel to power their nuclear power plants. How can we be sure that the inventories have been running low? Well, there's no way that they would be contracting more and more pounds if there were plenty of inventory left over in the spot market. That's what they used to do here. And we've seen the spot market rise sharply. Look how sharp that is over the last 2 years. That does not occur if it's easy to find that particular commodity. Okay, so those are two very, very good clues to give us confidence in such an opaque market around inventory levels, and that they are in fact becoming more and more skinny. If we look out a little bit further, there's a hell of a lot of demand being, particularly from China, but the Japanese fleet is being restarted. There's a lot more demand coming online. I love Justin to talk about that. And then where we have our supply, you can see the secondary supply is basically being eaten through. And we are expected to have a massive gap between where the demand is, even on the base case, and total supply, both primary and secondary, moving into the future. Alrighty, where are we at in terms of the spot price itself? So here I'm looking at the futures for U308 on the COMEX over the last 5 years. Over the last year. Here we've got 55.6. What I wanted to draw your attention to was mainly just some of these momentum indicators. So the RSI here is off the chart in terms of buying action. You can see where we were in March, and that has just absolutely flown upwards, meaning there's a lot of buying momentum quite recently. And then on the MACD, of course, we're well above the zero line, and we probably have some crossover there. It's a bit hard to tell. If we take a look at the ETF, so historically, where has this thing traded? We've got a little bit more, we're above the zero line on the MACD. RSI is basically in the middle. Whilst we've seen, should go back. Whilst we've seen an increase in the fuel price, the U308 spot price, and momentum, we've actually seen a decrease in buying momentum for URA in terms of the ETF, which of course makes no sense because the fuel is going up. The guys that sell that very same fuel are apparently going down in price. This was a great lesson I learned when coal was going through the roof and Whitehaven coal had barely budged. And you had this massive alligator jaw between the coal price and the stock price basically didn't move. So I didn't make any money. I didn't invest. I was kind of new to the coal space, didn't know much about it. But I remember that. I remember thinking, okay, next time I see something like that, that deserves more close attention. And I think we're really starting to see that in terms of the uranium miners. So back in the day, back before the bear market, last legs of the bull market here around 2011, and we were trading pretty close to triple figures there. Okay. If we were to get back there, that would obviously be a 5x on an ETF. So to be able to have a sector, broad sector risk, which is fairly limited, and get a 5x upside, is a very attractive idea. I'm not saying it's going to happen, but it's something that I'm very interested in, and hence why I have a lot of weighting towards this idea. So when do we buy the miners? When do I buy the fuel itself? That's a question that I always like to ask, because the fuel's already been dug out. It's had expended energy needed to extract it from the earth, and you've already got it in your hands. Well, not uranium, of course, but you know what I mean. Any kind of commodity, gold, silver, whatever the case may be. Do we buy the guys that produce it and get some leverage to the upside? Or how's it trading in terms of just the actual commodity itself? So a ratio here between the ETF divided by, in this case, uranium futures. You can see URA has only been cheaper, a couple of times recently, which were back in last year. And then before that, you had to go back to sort of the COVID depths to see where this thing was trading in terms of the miners trading below the fuel price. So what this means is how many units of UX1 is it taking to buy 1 unit of URA? So when this thing is low, it means that the fuel UX1, the futures contract, is expensive relative to the miners, the producers. And obviously at the other end, the reverse is true. So I would be seriously looking at a reversion here. Personally, I'm expecting this ratio to halve, or for the miners to double in relation to where URX trades. Excuse me. That can be a combination of URA selling off, or the spot price obviously increasing. Any of those outcomes would have the same effect on the ratio. We've got a little bit to go before we hit the 200-day moving average, but once that technical indicator would be hit, if it would be hit, I think potentially we could see a breakout like we saw here back the last time it really crossed over. That was a false breakout, came back down. I think this time could really play. So then we say, okay, well, what's in the ETF? Could we just buy the best or heaviest holding in the ETF? The heaviest holding, and probably the best holding, arguably, is Cameco. And so why wouldn't I just overweight Cameco a little bit more? And the reason is because it's very expensive relative to the ETF. Okay, so at the moment, Cameco is basically never been more expensive compared to the ETF in the ETF's history. So that would be why. As the market goes on, perhaps you'll see the juniors go through the roof. Maybe there'll be a massive risk on speculative event. I don't know. And Cameco may trade a little more cheaply compared to the rest of the sector. We'll wait and see. But for now, guys, sitting back and relaxing, it's over 10% of the portfolio is in the uranium sector. It is volatile. It's not something you want to be checking every 5 minutes. This is the thesis. We know the direction. Well, I'm highly confident the direction in which I think it's going due to the supply-demand fundamentals. And so I hope that you find this little update helpful. Make sure you check out the link to Saad's article and stay tuned for the upcoming podcast with Justin Hune, the Uranium Insider. Take care, guys. I'll see you in another video shortly. If you want to copy the portfolio, link in the description. If you want to leave a comment, please do like and subscribe. It's great for the algorithm. Take care. We'll see you next time.